Welcome back to the deep dive. Wow, if you felt that turbulence in the crypto market lately, you definitely weren't imagining things.
Not at all. It's been quite a ride.
Yeah, so today we're diving into what feels like a really high pressure moment. We've got source material covering like three big forces hitting all at once.
Perfect storm, you could say.
Exactly. Our mission basically is to pull apart the key insights from this storm. We're talking a big price drop, some really specific institutional money movements, and then these kind of explosive regulatory and political headlines that just landed.
It's a lot to unpack.
It really is. The main event, I suppose, is Bitcoin testing and actually breaking below for a bit that huge psychological level, the $100,000 mark.
That was the trigger, wasn't it?
For sure. And that dip, well, it sent shockwaves, as you'd expect.
Mhm.
But the really interesting part, I think, is how the big money reacted and where some of that capital went instead.
Yeah, it was a fascinating moment of market stress. I mean, when Bitcoin actually dipped below $100, first time since June, you could just feel the sentiment shift almost instantly.
Right.
We saw this rapid realization of risk, and it was amplified by liquidation mechanics that were kind of lurking there already.
Okay, so let's get into those mechanics.
Yeah.
What did the immediate fallout look like? And what are the technical signs telling us now? Is there more selling pressure baked in?
Well, that initial drop was the catalyst, right? Forced immediate selling. And our sources point out that the average relative strength index, the RSI, across the whole market is now down at 38.
Okay, 38. For listeners maybe not glued to charts all day, what does that number actually signify?
Now, 38 is definitely depressed. The RSI, it measures how fast prices have changed recently to show if something's overbought or oversold. A reading like 38 confirmed selling has been really dominant, quite sustained.
So oversold territory.
Yeah, heavy oversold territory. But importantly, not quite at those extreme lows where you'd almost always expect an immediate snapback rally. It's heavy.
Got it. Heavy. So operationally, what are the absolute key levels everyone's watching now?
Right now, it boils down to two critical markers. For Bitcoin, it's $99,000. If we see BTC close below that with significant volume, that's bad news.
And for Ether?
For ETH, it's $3,100. If either of those levels broke convincingly, then the whole idea of an immediate technical bounce, that thesis gets invalidated.
And losing those levels means...
It likely accelerates the pressure
Yeah.
dramatically, especially for altcoins.
Oh, yes, the altcoins. It always feels like when BTC and ETH catch a cold, the alts get full-blown pneumonia. Why is the pain so much worse for them?
It's this vicious cycle, really. Comes down to structural issues in those markets. Two big factors stand out: shallow liquidity and distorted leverage.
Shallow liquidity, meaning it's hard to sell large amounts without crashing the price.
Exactly. Think about it, right? If you need to sell, say, $10 million of Apple stock, the market barely notices.
Yeah, no problem.
But try selling $10 million of some smaller altcoin with thin order book. It's like, I don't know, trying to sell 100 luxury cars in a tiny town that only buys 5 cars a week.
Okay, I see. The price just has to plummet to find any buyers at all.
Precisely. The buy side just can't absorb that kind of size. And then when the price crashes like that, it triggers forced liquidations on all those highly leveraged positions. That's the distorted leverage part.
Which forces more selling.
Exactly. More market selling, which pushes the price down further, triggering more liquidations. It turns a standard dip into a full-on cascade.
Wow. And what are the bigger picture macro drivers pushing this stress right now?
Well, the sources point to a few things. The U.S. dollar remaining stubbornly strong, some instability in tech stocks, and this is key for our next topic, those really significant outflows from the spot ETFs.
Okay, we'll definitely get to the ETF flows, but before we do, I saw something interesting in the notes. Even while everything else was, bleeding out, one little corner of the market held up relatively well. Privacy coins.
That's right. Monero XMR was actually cited as being up on the day in some reports.
So what does that tell us? Does it mean some money was looking for safety within crypto, not just fleeing the whole asset class?
I think that's a fair interpretation. It signals a kind of flight to safety inside the storm. When volatility spikes like this, sometimes investors look for assets they think have low correlation to the main market movers.
Or maybe assets with a specific use case beyond just speculation.
Exactly. Privacy coins often attract capital that prioritizes censorship resistance or, transactional independence, things that aren't necessarily tied directly to ETF flows or political headlines.
So they can be less reactive?
Potentially, yes. It's a good reminder that crypto isn't monolithic. Correlation isn't 1.0 across the board.
That's a really great point. Okay, let's pivot now to what might be the biggest source of that immediate pressure. the institutional flow report. Fund movements. I mean, that's where the rubber meets the road for price, right? They hit the spot market instantly.
Absolutely. They're often the why behind really sharp, rapid moves.
So was it fear on the charts driving the fund outflows, or were the outflows driving the fear on the charts? Chicken or egg?
I'd say in this instance, the outflows definitely amplified the price move. It turned what might have been a correction into more of a shock. The data we have suggests this was a pretty massive unwinding of positions.
Likely institutional profit-taking, or maybe risk limits being hit?
Could be either or both. The numbers themselves are pretty dramatic.
Lay 'em on us.
Okay, so get this. Total redemptions from the spot Bitcoin and Ether ETFs added up to almost $800 million in a single day.
Wow. $800 million.
Yeah, Bitcoin funds saw the brunt of it, about $578 million in net outflows. Ether funds weren't far behind, relatively speaking, adding another $219 million out.
Nearly $1 billion pulled out of those structured products that has to force massive selling pressure onto the open market.
It absolutely does. The market simply can't ignore that kind of forced selling.
Okay, so $800 million out in 24 hours is a huge signal of something. Risk off, profit taking, whatever. But there was this, like, quiet counter-narrative happening at the exact same time. Tell us about the rotation.
Yeah, this is where it gets really interesting. Amidst all that BTC and ETH bleeding, we saw what the source material calls a silent rotation into Solana.
Solana. SOL funds were seeing inflows.
That's right. They actually registered their sixth consecutive session of inflows, pulled in about $14.83 million during that same period of massive BTC outflows.
Sixth straight session?
Yeah.
While the big guys are tanking. That's noteworthy.
It's definitely noteworthy for investors looking at patterns, seeing consistent, measurable inflows into one specific asset, especially when the market leaders are collapsing. That signals something.
What does it signal? That some sophisticated money thinks SOL found a local bottom. Or maybe they're actively rebalancing.
Could be both. It suggests certain capital pools are making a specific bet on SOL, maybe relative to the others. This is potentially actionable data for traders.
How so?
Well, while the big outflows are driving negative sentiment everywhere, these tactical inflows into SOL might suggest, say, a pair trade opportunity, like going long SOL against a short basket of the broader market.
Interesting. But risky, I imagine.
Oh, absolutely. Any trade like that needs really disciplined stop losses and careful risk management. It's not a sure thing, just an observation from the flow data.
Right. Okay, so we've got the technical pressure, the market structure issues amplified by these huge institutional outflows, countered slightly by this rotation into SOL. Let's bring in the third major vector now, the sort of systemic risks and compliance costs coming out of Washington.
Yeah, this bucket we can maybe call the price of compliance. We saw a couple of really high-stakes headlines land almost simultaneously this week. They both introduce volatility, sure, but maybe more importantly, they signal shifts in the operational landscape for crypto businesses.
Okay, what were they?
First, on the security front, a pretty serious warning came from the U.S. Treasury Department. They announced new sanctions.
Sanctions against who?
Individuals and entities linked to North Korea, specifically for laundering stolen crypto assets.
Ah, the DPRK cyber threat. That's a persistent issue, isn't it? The scale is huge.
It really is. The Treasury statement reiterated that actors linked to North Korea have stolen something like $3 billion over the last 3 years.
$3 billion. Wow. And it's not simple stuff, right? It's advanced malware, sophisticated social engineering.
Exactly. And the takeaway for the legitimate crypto industry here is pretty clear. The pressure on KYC, Know Your Customer, and AML anti-money laundering controls. It's only going to intensify. Everywhere. Exchanges, protocols, everyone.
Makes sense. They want to choke off the avenues for laundering that stolen money.
Precisely. And beyond just KYC-ML, the reports really hammered home the need for constant operational security, OPSEC.
Meaning what, practically?
For anyone listening who's a developer or runs a project, it means extreme vigilance against things like sophisticated phishing or social engineering attacks, like those fake job scams targeting engineers to try and get system access.
All right, those have been nasty. So geopolitics might not set the daily price, but it definitely sets the long-term cost of doing business securely and compliantly.
That's a perfect way to put it. It dictates the compliance cost. Now, shifting from security to policy, we also had quite a bit of political noise around Changpeng Zhao, CZ, the founder of Binance.
Yes, the presidential pardon. What was the update there?
The White House actually came out and publicly defended the decision to grant CZ a pardon. They stated the case was reviewed with, quote, the utmost seriousness through all the standard procedures.
Okay. And this comes, obviously, after Binance paid that massive multi-billion-dollar settlement, and CZ himself served his time for the historical AML failures at the exchange.
Correct. And almost in the same breath, headline-wise, the current Binance CEO, Richard Teng, had to publicly deny something else.
What was that?
He denied that Binance had any influence over the choice of stablecoin used in a big deal with an investor in Abu Dhabi. The stablecoin in question was USD1.
The one linked to the Trump family's crypto venture.
That's the one. So Teng had to push back on any suggestion that Binance steered the deal towards that specific stablecoin.
Okay, so sanctions targeting North Korean laundering on one hand and high-profile political defense of the CZ pardon, plus this denial about the Trump-linked stablecoin on the other.
Yeah.
How should we view these politically charged events from a market perspective?
Look, putting aside any personal political views from purely a market or risk analysis standpoint, these are what we call volatility vectors.
Meaning they inject uncertainty.
Exactly. They create binary headline risk. The CZ pardon defense, for instance, ensures crypto stays right there on the political front lines. That means market participants, companies, they have to factor in ongoing political scrutiny, maybe allocate more resources to legal, to compliance, to lobbying.
It just raises the stakes and the operating cost.
It really does. These events shape the regulatory roadmap, which in turn shapes future compliance burdens and security needs for everyone in the space. There's no escaping it.
Okay, that's a clear picture of the external pressures. Let's pivot now, maybe zoom in a bit to the DeFi world decentralized finance. There's an example there of a protocol trying to fight back against these headwinds, using its own internal tools, right?
Yes, exactly. We're looking at Aave, which is one of the big established lending protocols. They just had a major governance vote pass, unanimously, actually.
What did they approve?
An annual token repurchase program, a pretty substantial one, worth $50 million per year.
$50 million a year buying back their own token, AAVE. That sounds like a deliberate move to manage supply and support the price.
It absolutely is. And it's not totally out of the blue. They apparently ran a successful pilot program before this.
Oh, really? What happened with the pilot?
The pilot reportedly acquired over 94,000 AAVE tokens, which was worth around $22 million at the time. And during that pilot, the AAVE token price initially jumped over 50%.
Okay, so they have some precedent suggesting this could work. How will the new $50 million program operate?
They've laid out clear parameters. They'll be making weekly purchases ranging anywhere from $250,000 up to $1.75 million per week. Publishing those parameters adds a good deal of transparency, which the market usually likes.
Right. Transparency is good. But here's the million-dollar question, or maybe the $200 question in AVE's case. Can a buyback program, even a big transparent one like this, actually shield the token from a market-wide downturn? Can AVE get back to, say, $200 just because of this?
Yeah, that's the crucial question, isn't it? And the honest answer is it's complicated. Programmatic buybacks like this, they're definitely a powerful tool for long-term deflationary pressure. They reduce supply over time, but
Right.
they probably can't entirely insulate an asset from the broader market trend, from the market beta. A beta, the token, has a very, very high positive correlation with Ethereum.
Meaning if ETH goes down, AAVE usually goes down too, regardless of buybacks.
Oh, pretty much. If ETH were to break that $3,100 support level we talked about, even the best designed buyback strategy is likely going to see the AAVE price struggle. The macro correlation often just overwhelms the specific tokenomics in the short term.
And is there anything else complicating the picture for AAVE right now?
There is, actually. Recent on-chain data apparently shows that AAVE inflows to exchanges just hit a 7-month high.
Inflows to exchanges that usually suggest people are moving tokens to sell them, right?
That's the typical interpretation, yes. It suggests that maybe the announcement of this big buyback program is actually prompting some holders to sell into that expected support, maybe take some profits off the table.
So the buyback program might be creating its own short-term selling pressure to fight against.
It seems that way. It highlights the conflict, Governance works, it's transparent, but even a solid buyback plan can't just magically stop drawdowns if the whole market tide is going out. It's fighting momentum.
Okay, this is a lot to digest. We've got the shaky technicals, the huge institutional rotation out of the majors, but into SOL, these persistent regulatory and political risks, and then DeFi protocols trying internal fixes like buybacks. It feels volatile. How do we tie this all together into some kind of strategic framework for someone listening?
Yeah, it's crucial to have a framework. I think we need to think about it in different time horizons. Let's start with the very short term, like the next few days or weeks.
Okay, what's the play short term?
Respect the technical map. Those levels we mentioned, 99K for BTC, $3 1K for ETH, they aren't just random lines, they're where high volume traders are making decisions.
So if they break down,
If they break down convincingly on high volume, then risk adjustment becomes pretty much essential. You can't ignore it. But if they hold, especially while the RSI is still so depressed, then you could see technical relief bounces. Maybe short-lived, but possible.
but you said the macro drivers like the strong dollar and maybe ETF outflows are still a headwind. How much faith can we put in those technical levels holding? Aren't they just targets for sellers?
That's the tension, exactly. Confidence in technical levels holding is pretty low unless the underlying flow picture changes. Which brings us to the tactical takeaway.
Which is,
Monitor those ETF flows like a hawk, daily. If you keep seeing huge BTC and ETH outflows, but SOL inflows persist, that confirms the rotation narrative and suggests maybe that pair trade idea has legs. But again, discipline is key.
and manage leverage carefully, especially with political headlines flying around.
Absolutely. Avoid high leverage when you have that kind of binary headline risk, like fallout from the CZ pardon stuff or new sanctions. Those can whip the market around instantly.
Okay, that's the short-term tactical view. What about the medium term, looking out over the next few months?
Medium term, the macro risk definitely stays elevated. As long as the dollar is strong and there's uncertainty about when or even if the Fed will cut interest rates, that's a damper.
But does a sharp drop like this kill the whole cycle?
Historically, no. Sharp, nasty drawdowns like this usually don't kill bull cycles all by themselves. What they do is violently shake out all the excess leverage, clean up sloppy positioning.
A forced reset, kind of.
Exactly. And sometimes, if you still believe in the long-term fundamental story, these shakeouts can actually offer up some pretty attractive entry points with better risk-reward asymmetry if you have the stomach for it.
Right. And what about the lessons from the regulatory and security side? How does that fit into the medium-term view?
I think the big takeaway there is that robust OPSEC and solid compliance. They aren't just nice-to-haves anymore. They're becoming table stakes.
Meaning investment in those areas will pay off.
The sources suggest yes. The projects, the exchanges, the institutions that really invest in building resilient compliance and security frameworks, they're likely the ones who will attract and keep the more stable, long-term, sticky capital. They'll differentiate themselves from the riskier parts of the market.
Makes sense. Build trust, attract better capital. Okay, so bringing it all together, what's the final sentiment check? Where are we now?
Sentiment has clearly flipped. The break of that big psychological $100K level definitely shifted things towards fear, which honestly just reinforces the idea that solid risk management is way more important right now than trying to perfectly guess the absolute bottom.
Wise words. Okay, that is a fantastic framework for navigating this. We covered a ton of ground today in this deep dive. The market testing, that crucial $100K support, those really stark institutional flow, contrasts big money leaving BTC ETH while quietly rotating into SOL, and these enduring political and regulatory risks that keep driving up the cost of doing business.
It's a complex picture for sure. And maybe here's a final thought, something provocative for you to chew on as you process all this.
Go for it.
When we see these reports of whales or long-term holders taking profits, and that causes this kind of short-term supply glut and price pressure, it can feel really scary in the moment, like the whole thesis is broken.
Yeah, it feels like the smart money is heading for the exits.
Right. But that profit-taking, that realization of gains, it doesn't necessarily mean the entire long-term bullish case for the technology itself is invalid. It might just mean the market is doing what markets do: repricing risk, cleaning house after a big run-up, and rebalancing positions.
So separating the short-term noise from the long-term signal.
Exactly. Your critical mission right now might be just that, trying to differentiate between the short-term, maybe panicked, noise, and the underlying long-term thesis that you actually hold conviction in. That's the real challenge in moments like these.
That's a great place to leave it. Excellent synthesis. Thank you again for joining us for this deep dive into the source material. We'll see you next time.